Good afternoon, everyone, and welcome to SCORE's weekly or bi-monthly webinar. I'm Steve Smith, and I'm the webinar coordinator here at SCORE. Today's webinar is on new tax laws and the impact that this will have and they will have on individuals and businesses. And our presenter is Scott Herckis. I'll tell you more about Scott in just a minute, but first I'm going to tell you a little bit about SCORE. I know many of you have been on these webinars before. I can actually recognize some of your names, and I appreciate your loyalty to our program. But you're going to have to listen to my extolling the virtues of SCORE one more time. SCORE is a national organization as a part of the Small Business Administration. It was set up in the mid-'60s, actually under the Johnson administration, the idea being to get the knowledge of retired business executives and to make them available to small businesses and entrepreneurs so that they could grow fast and prosper. So the program has been going on for quite some time. There are over 300, somewhere around 325 offices around the United States and over 11,000 volunteers. Today, I would say the profile of SCORE is probably 2/3 are retired executives and 1/3 are executives either running their own business or volunteering their time and working at the same time. Here in Fairfield County, we kind of encompass the territory from the Greenwich, New York border all the way up through and including Bridgeport and up to Danbury. We have 130 some odd volunteers currently, and we have individuals who are expert in all kinds of different processes like sales, marketing, accounting, supply chain, things of that nature, as well as having industry expertise and subject matter expertise, some of which are like we're going to hear today. There are three services that we deliver into the marketplace. Not in any particular order. One is workshops and webinars. That's what you're doing today. From the workshop point of view, those are live face-to-face events. We do them primarily at libraries around Fairfield County, and we do about 125 to 130 of those per year. They run from 6:30 or 8 o'clock at night, so it's a different kind of a format, face-to-face after work. The webinar program really grew up about 2.5 years ago to meet the needs of people who, quite frankly, wanted to go home to their families at 6:30 to 8 o'clock and didn't want to spend 2.5 hours. So we cut it down, put it in the middle of the day, and it's been very, very successful. We also do, and I think probably our primary service to the community, really, the small business community, is our one-on-one counseling and mentoring. We do that at our offices at 111 East Avenue in Norwalk. That's where we're sitting now. That's where our counselors are available to sit down with you and work on very specific problems to your business, whether it's anything from getting started to opening up a new branch and do a new set of customers for an existing business. The other thing that I would encourage you to do, and I'll probably say this at least 3 more times in the next hour, is to go to our website, which is fairfieldcounty.score.org, fairfieldcounty.score.org. And you'll see a whole long list of resources and tools and frequently asked questions that small businesses ask that are available directly online. Tremendous amount of intellectual capital there, and I would encourage you to go to that and search and see if we don't have part or all your total answer to your questions online. Okay, so we're about ready to get going here, but I got to tell you that we're going to have a little bit of a switch up for those of you who know this format. Our next webinar is not going to be in 2 weeks, which they usually are. It's going to be in 1 week, and the subject is going to be jump-starting your startup. You've probably already gotten your first marketing piece on that, and you'll get another one 3 days prior and one the morning of. Now, today's webinar is being recorded. I'll say that one more time because I always get that question. It is being recorded, and this webinar will end sharply at 1 o'clock. The link to the recording with the slides and the audio will be available by the end of the day, I'll say for sure by tomorrow, at fairfieldcounty.score.org. Just merely click on Take a Webinar, and then when you get to you'll go actually to YouTube, and you'll see it there. Now, as far as Q's and A's are concerned, please ask them as we're going along here. We want this to be as interactive as a webinar can possibly be. I'll be watching the chat room, so when you put a question, it'll go right down into the left-hand corner there, and I'll feed those to Scott. We'll try to get this as interactive as possible. It's not a stand-up, face-to-face format, but we're going to make it as interactive as possible. One more thing. At the end of the webinar, you're going to be receiving a questionnaire asking you to evaluate the quality of the webinar. We appreciate your input on that, and I do look at them after every webinar to make sure we're doing the right thing for you. Now, on to Scott. Scott Herckis has over 20 years of finance and accounting experience. He started his career at Arthur Andersen Consulting in the audit and assurance department, where he got his the CPA license. He's also worked in the consumer products industry. He started his own business in 2009, SJH. I think we can figure out what some of those letters mean. Financial, and he provides outsourced CFO services. I'm going to say that again. It sounds pretty creative to me. Outsourced CFO services for small and medium-sized business. He also prepares tax returns for businesses and as well as individuals. This webinar will have both an individual and a business focus on it. And again, please put your questions in the chat room. I'm going to turn it now directly over to Scott, and let's have a go at it. Scott, go ahead.
Okay. Good afternoon, everybody. Thank you for taking some time out of your day, especially during the lunch hour, to come and listen. I really appreciate everybody attending. Also, before I get started, I'd like to give a big thank you to SCORE. I've done multiple presentations with them over the years, and each one's been really enjoyable. I do have to admit this is my first webinar, so please bear with me and be gentle as much as you can through this whole thing. So with that, I'm going to reemphasize exactly what Steve just mentioned a moment ago. I'm talking about taxes. It's not the most enticing and exciting thing in the world. So answering specific questions and being interactive, I think, is really important to making this worthwhile for everybody who's attending. So please don't hesitate to reach out with any of the questions along the way. Okay, so the topic, new tax laws and the impact of individuals on individuals and businesses. So this is going to be in two phases. First, we're going to talk about the individual tax laws for a period of time, and then we'll toggle over to the business. Quite a bit more complicated, a lot more nuance to it, so we can certainly spend more time on that as we go. All right, so did that move? Double click. All right, there we go. Uncle Sam, the new tax laws. As mentioned, we're covering two topics today, both on the individuals first, and then we'll get over to the business in just a moment. Okay, so one of the main changes with the new tax laws are the tax tables. There are still 7 tax brackets, going as low as 10%. That hasn't changed. One of the bigger news is that the top tax bracket has gone down from 39.6 to be exact to 37%. Not only that, but that threshold doesn't get reached now until you're over $500,000 if you're single or $600,000 if you're married. Compare that to the old tax laws where it's about $425,000 and $480,000 respectively. So if you're in or approaching that high tax bracket, there's a potential savings of at least 2.6%. So that's nice news. And also going throughout the table, it scales at a much, not a much lower, but a somewhat lower rate, so that all else being equal, if everybody makes the same from one year to the next, they should see a decrease in their tax bill. Now there's a caveat which we're going to get to because there are a lot of other changes that go along with that along the way. The first thing that I want to talk about on the individual side that's changed are the standard deductions. They've actually gone up, and they've gone up quite considerably. Now, starting in 2018, standard deductions are $12,000 for singles and $24,000 for married couples. Both of those numbers are almost double what they were in the prior year or in prior years. So anyone who had been just taking the standard deduction before, they're in for a very nice change in terms of what they're getting to write off from the deduction standpoint. Moving to the itemized deductions, there are a lot of changes in here and things that have been increased but also unfortunately decreased quite considerably. One of the biggest changes has to do in the, let me double click on this. One of the changes that has to do is with the home mortgage interest and HELOCs. In the old tax law, if you had your home mortgage, you could take the interest deduction for up to $1 million of debt. That's now been pared down to $750,000. So if you have what would be in many parts of the United States, but not necessarily in Fairfield County, if you had a considerably sized home, that deduction could go down. However, let me be very clear about this. The debt is grandfathered. So what that means is if you owned a home and had up to $1 million worth of mortgage interest in prior years, you're still going to be able to get that up to that $1 million deduction of interest. Additionally, if you go to refinance your home, even today or next year or something to that effect, and you had a mortgage that was up to $1 million, you're still going to be able to have that $1 million cap as opposed to $750,000. So don't hesitate or worry about refinancing your home and thinking that if you were between $750,000 and $1 million, that you might lose some of your mortgage interest. Okay. On the HELOC side, things have changed quite a bit. In the prior laws, you had up to $100,000 worth of mortgage HELOC interest that you could deduct. Now, you can still deduct that if the money that you use from that HELOC is used for improvements in the home. So if you take a home equity line and you go and you put a new kitchen in, you remodel a bathroom, or do improvements on the house, you can still deduct up to $100,000 for uses such as that. The bad news is that in the old days, you were able to deduct up to $100,000 and use it for anything. You could go on a trip, you could buy a car, you could pay off credit card debt, anything you wanted to. That is no longer eligible. So that's an important distinction and something that you should definitely want to keep track of and be able to demonstrate, if you're going to be able to take that deduction, that you demonstrate that you used it for the right things. So that's a big change going in 18. Send in those questions, guys. I'm waiting for them. All right. Next. This is one of the kind of the bigger disappointments, especially in the Fairfield County area. State, local real estate, and property taxes. In the past, those were all deductible and had no cap. So in many cases, people who owned a home and worked in Connecticut that paid a fairly sizable state tax, those items were all deductible, and people took advantage of those situations. That has now been capped at $10,000 a year. So if you own a home, let's say, and your real estate tax on that home are, say, $15,000, you're only going to be able to take $10,000 of that $15,000 now. Additionally, any of the state taxes that you pay on your income that were in the past were deductible in addition to that real estate tax, that's now gone. And the state and local taxes, and property taxes on vehicles, which is common in Connecticut and also used to be deductible on top of that, also goes into this cap of $10,000. So I've already seen, just coming out of tax season and watching a lot of people come by, I've seen a lot of people who are going to get hit dramatically with the reduction of this itemized deduction, state and local taxes. So that's an important one that people are going to want to think about and try to figure out ways around it. An interesting side note, some states are very unhappy with this new law, so much so that they're trying to write laws to circumvent it. So here's an interesting little side note. State of New York, this is something that I wasn't even aware of until last year. You can make a donation to a state at any time, and those donations to those states can be considered charitable deductions. It's a nice thing to have. What the state of New York is considering of doing is saying, okay, if you make a deduction to the state of New York, rather than having to pay your property taxes, we'll give you a dollar-for-dollar credit on those donations. So what that means is if that law passed, you could make the donation to the state of New York for the amount of your property taxes. You'd be able to deduct that in the charitable donation section, which hasn't changed at all, and then you wouldn't have to pay any property taxes, which you're not going to be getting that deduction on anyway. So it's going to be interesting to see how states like that play out and whether that actually comes to pass in places like New York and Connecticut.
Yeah, this is Steve Smith again. That's going to be interesting. I do have a question here, which is a little bit going just a tiny bit backwards. It's from Jacqueline Peebles, who asks, can you please repeat the new standard deductions?
Yes, absolutely. So the new standard deductions are $12,000 a year if you're single, and $24,000 a year if you're married filing jointly.
Go ahead. Yeah, go ahead. And this actually is from somebody here in the room on the $10,000 cap. You want to take that one?
I see that. So the $10,000 cap is for all of those deductions, state and local, real estate, property, all combined. So you add them all up, and anything above and beyond $10,000 is not deductible. I wish it were $10,000 each, but no, it's a total of $10,000. It's a good question. Thank you for clarifying that.
Yeah, they're coming in. So I'm going to let you go ahead and William Horton says, I thought you have to reduce your charitable gifts by the value you receive. State cap. I don't know if that's quite finished or not. Can you answer that? Does that make sense to you?
I'm going to make a different example. If you go to a charitable event and they serve you a dinner, let's say, and they value that dinner at $100, but you paid $250 to go to that event, you would be able to get a charitable deduction of $150. The difference between the dinner that you actually ate and the value of that versus the amount that you actually paid. That's the amount that's deductible. What they're offering is giving just a donation to the state, and that donation is you're not getting any value for it, but you are getting a credit that is going to be able to be used against your property taxes. So it will certainly be written and done in such a way so that if you do make those donations with the intent to get a credit for your property taxes, that you then wouldn't lose that donation because you're getting value for it. So it's an interesting kind of tidbit and something they're going to have to be very careful of if and when they write these laws, to make sure that it doesn't backfire on them and get lost. And oh, by the way, if we're going to go down this road, the federal government is not happy about this at all, and they are going to be looking to challenge these cases in court too. Again, if it goes forward.
Yeah, William, I think you hit the nail on the head. He says, I guess it'll be decided in the courts. Yeah.
It will most likely go to court.
Yeah, and then Alicia's asking, he's wishful thinking, I'm afraid, at this point, but is asking, is Connecticut considering a similar approach to New York, to the best of your knowledge?
I have not seen anything out of Connecticut yet. New York seemed to make a challenge to that or an opportunity to that almost immediately after the tax law became law. But I would envision that a state like New York, or I could also envision a state like California, which also mentioned it, if it passes and it is successfully upheld in the courts, I think there would be a floodgate of states that will follow in their path. So I would think that Connecticut would fall right behind New York if and when these types of things passed. Let me be clear. Nothing's been passed. As far as I know, there's no legislation that's up for a vote or even in discussion. It's just been a topic that has been broached at the state level in Albany.
I think I skipped over a question back here to Omar. Back when we were talking about the standard deductions, I think if I can get this right, he's asking. You said if you're single, you get one deduction. If you're married, filing jointly, it's another. His question is, what if you're married but filing separately?
That's a good question. Married filing separately for most tax laws are treated like singles. So if you think about it, if there are two people who are married, rather than them both getting, say, $24,000, they would get $12,000 each, which would work out to be the same when they file both their tax returns. It would total $24,000. So that's common for most things, where they're usually half for a single and double for married couples, including.
And then Jacqueline's asking, head of household, I guess. Let's see, I'm not sure how she's. What that? I think it must be.
We'll double check the head of household. I believe they gave up to $18,000. And for those of you who are questioning what is head of household, head of household is typically a single individual or a person that's not married, but also has somebody that they take care of in their home. They could be a single mother. They could have older parents. Those are two common examples. And if they qualify by taking care of them, then they have a separate tax bracket between singles and married couples. And it kind of falls in between, even though it's just one person. It's something that people take advantage of. I don't talk about it too much because it's not as nearly as common. I usually talk about singles and married couples. In this case, though, I believe that the head of household, the standard deduction falls in between. What I can do is I can verify that after the fact. I can get back to Steve, and he can let folks know, or I can get back to people individually. We can talk about how best to communicate offline as well.
Yeah, I would encourage you, in this particular case, to send Scott an email. You can see his email address right there at the bottom of his slides. Now I'm going to answer one more question here on this at this point, and then we're going to move on because I do want to make sure we spend a lot of time on the business portion of this. So this is Joan McDonald asking the question. She's saying, to clarify, if a taxpayer owns more than one house, does the cap on the mortgage interest deduction apply to the value of each house or all houses combined?
It's houses combined. So if you have a primary residence and then you have a secondary residence, say a second home, so let's use a common example for people in the Northeast, you have a second home in Florida, you get to combine those two mortgages together to get up to the $1 million threshold. And again, as long as you had both homes prior to when the new tax law went into effect, then you'd still qualify up to $1 million. If you owned say a single home now and you went and got a second home tomorrow, then that second home, then you'd be running up against that $750,000 cap.
Yeah, that's not the answer that Joan wanted or any of us did, but nonetheless, that's the answer. So we're going to go ahead and back to you, Scott. Take it on to the next slide.
Okay, we'll move forward now. All right, miscellaneous deductions. At the bottom of the itemized tax deduction page, there's something called miscellaneous deductions, and they're subject to a 2% floor. But what's common in those are things like union dues, things like unreimbursed business expenses. So if you are an employee who receives a W-2 and you have expenses that your employer doesn't reimburse you for, you typically were able to deduct these items in this section. Also, some job travel would also be qualified under there. Under the new laws, all of these go away. So forget the 2% cap floor, anything of that nature. Those are no longer deductible starting 2018. So an important distinction. I use personal examples. I have a couple clients who though they're W-2s, their employers don't reimburse them for certain expenses when they're traveling. They have to foot the bill, but they've been getting that tax deduction in the past, and that's now going away. Okay, alimony. This is an interesting topic that's come up for people who are divorced or divorcees. Starting after the 2018 tax year, so beginning January 1, 2019, alimony that has typically been paid and considered a deduction for those paying it are no longer going to be deductible. And reversed, people who had been receiving alimony in the past, starting in 2019, those would no longer be considered taxable income to those receiving it. Let me be very clear about this, too. This is a grandfathered law, similar to what we were talking about with the home mortgages. So if you have an individual who was divorced and has already gotten the divorce decree and has everything in writing, that alimony will continue on throughout the life of that decree. But if anybody gets divorced starting in 2019, that no longer will be the case. And an important distinction, if somebody is divorced but then they go back to court and they challenge and things get modified, it's potentially no longer deductible as well. So that's something to keep in mind. It's not a slide here, but I have notes on charitable contributions, and I did mention it earlier. I do want to emphasize charitable contributions for the purpose of this conversation, they are not changing at all. So those who would make donations in the past for whatever things they did, whether it was for goods and services or whether it was for actual checks being written, those will be staying the same. Okay, medical deductions. Medical deductions are one of the few things that actually improved in the itemized page. In the past, they were subject to a 10% floor. What does that mean? That means that let's say an individual earned $100,000 of taxable income. The 10% floor meant that the first $10,000 worth of medical expenses were no longer deductible. So anything above and beyond $10,000 would be deductible. That floor is actually decreased to 7.5%, both for the 2017 tax year that we just finished on April 15th, unless you're on extension, or in 2018. So if that same individual, they would only have to incur $7,500 worth of medical expenses, and then anything above and beyond that would be deductible. So that's something to keep in mind for those who do incur rather large medical expenses. And those expenses, by the way, are fairly all-encompassing. They include medical premiums. They include going to the doctor. They include medications. They include x-rays. They include most everything you can think of when it comes to medical, except for things that are either cosmetic in nature or something that is more preferential and not necessary. Okay? Oh, and just to finish that cap, it's for 2017 and 18. After that, going back in the 2019 tax year, that 7.5 is going to jump back to 10%. Okay, a couple more. Personal exemptions. You probably can't read this slide, but it's a cartoon that says, "I'm sorry, sir, but you may not claim Afghanistan, Iraq, and Libya as dependents." All right, it's bad accounting humor. I apologize. Having said that, starting in 2018, forget Afghanistan, Iraq, and Libya. Your children and other dependents are no longer going to be tax deductions as exemptions. The exemption deduction is going away starting in 2018. And another unfortunate cut on this. All right. Child tax credit. Child tax credit is essentially doubling to $2,000 for each dependent under 17. Child tax credits are a great tax savings if eligible. Unfortunately, it is typically for lower income individuals, but for those that do qualify for it, it's something that people sometimes I find miss or not realize that they're eligible for, and it's something they can really take advantage of and get a nice tax credit. Again, this is not a deduction, this is a credit. So they're getting the full $2,000 off of their tax bill if they qualify for it. All right. Last thing on individuals, 529 savings plans. So those who aren't familiar with 529s, what they are they're like IRAs and 401ks where people put money into the account and they're used specifically for college expenses. The nice thing about them is if you use them for college expenses, you can take the money out after it's grown and you can take it out tax-free as long as you're paying for room and board and things and books and supplies, things that are necessary for school, for your full-time students, for children going off to college. What's nice about it, though, what's new about it, rather, is starting in 2018, the 529s can also be used for elementary schools and high schools that are private and therefore require a tuition. You can deduct up to $10,000 per student per year going forward. So think of those who send their kids off to private schools. They can now use 529 plans to pay for these. And again, get the benefit of taking the money out tax-free when you do it.
So, Scott, let's hold up here a minute on these questions. We'll get way too far ahead of ourselves. Back to medical expenses. Get your brain back on that page for a second. Which schedule is best for medical expense deductions? 1040, Schedule A, Schedule C. They have I recognize Adrian from other webinars. We have a number of LLCs.
So the medical premiums that you pay are typically deducted, and they're deductible on the first page of your 1040 tax return. They're not even a part of the Schedule C. They're what's called in the adjustment section on the first page of your 1040 tax return. So, and you get that full deduction for the medical premium. So if you own your own LLC, you have a Schedule C, and you're paying for your own medical premiums, it is best advised to put those on your 1040 and get that full deduction for your medical premiums. For the other expenses, things like medical prescriptions and X-rays and going to the doctor and things like that, those would then fall into that Schedule A if you qualify for it. I hope I cleared that up for you, Adrian.
Yeah, thanks. Let me just back up here to Jacqueline again. Is losing the personal exemption just for the dependents or the taxpayer too?
It's everybody. So if you're married with 2 children, that's 4 people in total. All 4 of you are gone. There are no exemptions at all on the tax returns anymore starting in 2018.
Okay, good. And then, well, not good, but yeah, I understand. Ziomara asks, will people with ITIN still be eligible for CTC?
Yes, the eligibility should not change at all. In the questionnaire that, which is fairly all-encompassing on prior tax returns, the question shouldn't change. The only thing that's changing is the amount that you could be potentially eligible for is increasing and potentially doubling.
And then one more, what's the income level to receive the child tax credit?
It depends on several factors. It depends if you're single, depends if you're married. It also depends on how many children you have. So there's not a straight answer, but I would say that I believe, and again, I'm going off memory on here, I think the cap is around $75,000 of income. So if you're above that, you probably will not be eligible for any of it, and it starts at a much lower level.
So okay, one more on the personal, and then we're going to jump into the business, I think, right? Okay, so back to the 529 form, is it $10K per child for private school or $10K in total? Is it $10K per child or $10K in total?
It's $10K per child. So if you have 2 children at private school, then you could take up to $20,000. Good question, and thank you. I'm sorry I wasn't clear on that before. It's a nice deduction you can take.
Okay, all right, let's get into the business ones then, Scott.
All right, perfect timing. Okay. Okay, so with the new tax laws, there are questions. Should I become a C Corp? Should I become an S Corp? Should I become an LLC if you're starting a new business? Or should I switch if I'm currently one and I want to switch to another? Let me talk about the 2 main new tax laws as it relates to businesses, and this is where it gets really wonky. Okay, C Corps, they have reduced their top rate down from 35% down to 21%. And let me clarify, it's not a top rate. There is one rate now for C corporations. It is 21%. It is a flat tax. So whether you make $1 or $1 million as a C corporation, you pay 21% in taxes. Period. End of story. Also, this law is permanent. Oh, I meant to mention something on all these individuals. This is just to add a little fun to everything I just talked about. It goes, almost all of them go through 2025 and then they expire. So we'll be having this conversation again in 7 or 8 years and wondering what the new laws are going to look like. So I look forward to that webinar down the road. Having said that, going back to the C Corps are a permanent tax change from a graduated rate up to 35 down to a flat tax of 21%. So that does sound good, but keep in mind, the way C corporations work is they're subject to what most people commonly know of as double taxation. So the corporation pays 21% in taxes, but the money is still sitting in the corporation. In order for the money to then go to the individuals that receive those monies have to pay dividend income on those. Well, then the next obvious question is, well, what is the tax on dividends? The answer, of course, is it depends. It depends on your income. So if you are a single individual, up to $40,000, or a married couple, up to $80,000, you don't have to pay anything on dividend income. So if you are a small C corp and the amount that you earn, both in the C corp and everything else in your tax return, is less than $80,000, you could effectively take the rest of that money out and not pay any taxes on it. Okay. If you're above that, you'd pay 15% in dividend income up to either $420,000 if you're single or $470,000 if you're married. So if you're in that bracket, it's not exactly right, but effectively think of it as this way. You'd be paying 21% for the corporate taxes, and then you pay another 15% in dividends, so it'd be roughly 36%. It actually works out to a little bit less than that, but figure 36%. And if you're way above that, if you're in a very high tax bracket, then you pay an additional 20% in dividends. So you think of it as about close to 41% in total. Okay. Compare that to LLCs and S corps, and this also goes for sole proprietors. There's the new and most funky law that's come out is that S corps and LLCs are eligible for up to a 20% deduction on their net income. So if you make $100,000 on an S corp, in theory, you would get to take a $20,000 deduction on that income and only pay taxes on $80,000 on your net income. I wish it were that simple, but there are a lot of caveats to it. Let's talk about the caveats for a minute. If you are a single individual, the cap on that is $157,500. And if you're a married couple, it doubles, where the cap is $315,000. From there, it phases out. If you're single, it phases out over a $50,000 scale from $157,000 and change to $207,000 and change. Above that, you would not get any of that deduction. And if you're married, if you're at 315, it's a $100,000 phase out. It goes up to 415, and anything above, if you make anything above and beyond that, you wouldn't be eligible for that deduction. And if you're in between, you'd get a partial deduction. So let's say you're at 315 as a married couple. Let's say you make 365, which is halfway in between. You'd get a 10% deduction on that. Okay, but there's more. If you are in a field of what they call using your skill or reputation to do what you do for a living, for instance, being an accountant or a lawyer or a consultant or in healthcare or something to that effect, what I just described is the cap. There's no way around it, and you have to pay, and if you go above that threshold, you don't get any of the deduction. However, if you're not in any of those fields, let's say you own a retail store, and so you're selling goods and services. Well, that cap can be increased, and here's how. There's two ways. One is that you can deduct up to 50% of the W-2 wages that you pay your employees. The second is that you can deduct either 25% of the wages that you pay your employees plus 2.5% of what they call qualified business property. Qualified business property, the best and simplest example would be real estate. So let me try and give you two examples of what I just described, because I know it's wonky. Okay, let's say you were over that $315,000 threshold, or the $415 because it phased out. Let's say you earned $1 million from your small business. Okay. Typically and ideally, you'd be able to have a deduction of 20% or $200,000 of that. But again, you're way over the threshold. However, let's say you paid salaries of $200,000 to employees. Okay, you are actually eligible to take 50% of that salary payment and use that as a deduction, as long as it's less than 20% of your earnings. So again, if you made $1 million, 20% of those earnings are $200,000. Okay, that would be your max possible cap. But if you paid salaries of $200,000 to employees, let's say 50% of that number is $100,000. Therefore, you could still get a deduction of $100,000 on your $1 million of earnings because you paid salaries out to employees. Okay, let's go another direction. Let's say you made $1 million again, and you're still subject to that potential $200,000 deduction. Now, let's say that you paid no salaries to anybody. However, you owned a building, and that building had a value of $10 million. It sounds high, but it's certainly reasonably possible to own an office building of that amount. You would then take 2.5% of that $10 million building, which is $250,000, and compare that to the $1 million earnings that you made, and take 20% of that, or $200,000, and you take the lower of those two numbers, which is $200,000. So if you owned a $10 million building, even though you didn't pay any salaries to anybody, you could still take up to $200,000 deduction if you earned $1 million. Did that make sense to anybody out there? It's very complicated and it's very confusing. But what it's basically trying to do is they're trying to say, if you are a small business owner, but you are still making a lot of money, you may still be eligible for a deduction, even though it's above and beyond these somewhat arbitrary thresholds that they created of these $157,000 and $315,000 items. And they did that by saying if you pay wages to people, or if you owned real estate or other expensive business property, you would still be potentially eligible for some of these deductions. So let's put a cap on. Let's put this all into one little cap. If you are a C corp, you're paying 21% and probably another 15% or 36% in taxes. If you're a small corp, an S corp or an LLC, if you're earning under $315,000 as a married couple, you could deduct up to 20% of that. By the way, that $315,000 number, it's not based on the net income of the business either. It's also based on what your spouse earns. It also takes into account what your itemized deductions may be, and it looks at your total net income to see if you qualify for this 20% deduction or a part of that.
All right. So, yeah, Scott, we got a couple of questions here. I know this is very complicated. So, actually, Joe McDonald says this all makes sense. You asked if it made sense, and then she goes on to say, and you'll like this, but this will be the highlight of your day. Thank you, but I think the best thing for each of us to do is to bring our own individual details to you for an hour of paid consulting or more. Now, do you happen to have, is Joan, is that just your wife's name, or are you in business with her? Or?
A paid consultant of mine.
That was very good, Joan. But just a little humor here. So, but on a more serious note, Alicia Watkins asks, and she's talking about this real estate building deduction example you were just using. Would this apply to real estate that isn't a whole building? In other words, a home office used for retail, a sole proprietorship. It's two different things. If you're using a home office for retail, that's uncommon. Usually, when you're using a home office, it's because, and I actually have a home office, because you have part of your home that you're simply using and you're working in, and you're getting a deduction for part of your home for that. If you're using it for a retail store, that is an unusual circumstance. Now, having said that, it should qualify for what you would consider qualified business property, because you actually do own the property. You are using it for your business. You'd have to carve out and do the math. So let's say you had a home that was 1,000 square feet and your retail was 100 square feet. That 10% of the value of your home would be considered qualified business property. Yes, it should. Okay, and then that's good. I'm sure she's happy with that answer. And also, I guess it's fair to say that all this corporate tax stuff that we're talking about is also up for change in 7 years. Is that true? No, it's not. Most of the business laws that went into effect are going to be permanent. The C corp change is an absolute permanent change from 35 to 21, to be specific. Okay, good. All right, let's carry on here. And just for a time check, we're at almost 1:15. That seems right. We only have a few more slides, so I think we're going to be fine in terms of time. All right. So that was my slide on the S corps and the LLC pass-throughs. I did that not so you could sit there and read it, but just to show what kind of level of complexity this thing provides. It's complicated. Okay. A few more things. Depreciation. So one thing that the government has been doing, and this is not new, but they've
they've clarified or changed it a little bit for the new tax laws. They have encouraged small businesses to buy assets. It's good for the economy, it's good for businesses and things of that nature. They also didn't want to penalize them by saying that you had to put these items on your balance sheet and appreciate them over a long period of time. So what they've said is for the next 5 years, so this one is an example of something that's not permanent, but at least for the next 5 years, small businesses can expense up to $1 million of business property that you place in service during the year. So if you build a restaurant that can be very expensive very quickly, any of the income that you make on that you can offset with the purchases of all your assets in that current year. And also let me be clear about this. Let's say you use a restaurant and you spend $500,000 building that restaurant and you only made $100,000 the first year. You could then completely take a write-off of that $100,000, and then the remaining $400,000 of business property you can carry forward to future years and use that in the future. So basically what they're saying is all the investments that you're putting into these types of properties you can use to offset your income for a long period of time. And you can do it immediately, which is great. Okay. Meals and entertainment. This one is really kind of strange. And the reason I say that is because there's not 100% clarity on what the laws are that have been written. For those in the accounting world who have been really focused and trying to keep up with this as much as they can, there have already been a couple of loopholes on things that were supposed to be closed that really don't affect most people, but they affect. There was one loophole that was supposed to change to benefit farmers, and when they actually passed the law, they were supposed to change a percentage from one rate down to a lower rate. They actually passed the law without changing the rate. Nobody actually changed the number in the draft of the tax law that was passed. So now farmers are up in arms. It's really specifically for farmer cooperatives, and these cooperatives are kind of up in arms because they're losing what they thought they were going to get as a tax benefit, and it's hurting them. So that's what happens when you do these things very quickly and at the last minute, just so by the way. Having said that, let's talk about meals. There's really, as it stands today, there's 4 different types of meals, and they have 4 different types of deductions for them. The first one is kind of the most common, simplest one. You go out, you take a client to dinner, you want to entertain them, you want to write that off. That deduction is likely gone. I say likely because it really is gone, but there's not 100% clarity from the IRS or other places in the Treasury that have said that it's definitively gone. But for all intents and purposes, think that it will be gone, but also know that you should keep track of these things in case things change. Okay, so that's meal number 1. Meal number 2 is dining while traveling. So you have to go out of town on business. You want to take that deduction. That deduction has been up to 50%. That is still the case. So that's good news. One interesting question, and please don't ask this question because I'm going to ask it and not have a good answer for you. What happens if you go out of town on business, you go visit a client, and you take that client to dinner? Which one does this fall under? Does this fall under taking a client out to dinner, which is not deductible, or does it fall under the traveling on business, which does have a 50% deductibility? One of the things that I haven't gotten a clear answer on. All right? Thirdly, meals for meetings and employees. Let's say you have bagels on Friday in your office, or if you have a business meeting in the office with employees and you bring food in. In the past, that was considered a 100% deduction, kind of a fringe benefit, if you would. That's now been reduced down to 50%. Okay. The last one of example is, let's say you have a year-end party. You have a holiday party where there's food and there's drink and things of that nature. Or if you're doing what would be considered a presentation. Think of a realtor that might have food out if somebody's coming for an open house or things of that nature. Those are still 100% deductible. Okay. The important thing to keep in mind with the 4 examples I just gave you is if you do own your own business or if you do have to track these things, it's important to keep these into, don't call everything just meals, but actually keep them into these 4 separate categories we just mentioned because they're going to be subject to different write-offs, if any write-offs. And if things get clarified and changed down the road, and it'd be really helpful and important if you can keep these things into 4 different silos. So keep that in mind. All right. The last thing I wanted to mention on the business law are parking and mass transit. So the big change here is that if you are an employer, you used to be able to take a deduction by giving discounts for parking and mass transit to your employees. That's no longer allowed from the employer perspective. However, employees can still use pre-tax money for these items. So not uncommon, a lot of people live in Fairfield, they travel into New York City, and they take the train, and they pay with pre-tax money that they set aside for these things. That is still allowed, and it's still able to be used. However, again, the employer side, that would take if they offered any of those payments to employers and take those deductions are no longer allowed. That's important. That's my presentation for today. I know we covered a lot. There's also, believe it or not, there's quite a bit more that's out there, but these were the highlights that I think are relevant for the most people who are out here, and most people that are kind of in the SCORE universe, if you would.
That's great, Scott. We are a little bit before the hour, so I'm just going to show my slides of my trip in 1978 to Afghanistan. And while we wait, no, you probably don't want to see them, but it is a true story. I want to give 1 or 2 more minutes here for people to ask questions about the business side. Just one other thing that. Remember, we do have these slides and the audio on our website, hosted by YouTube. And since there is so much material here, and since the words are more important than the pictures, I encourage you to go to the website, click through to the webinar archives, or I think it's called on-demand webinars, actually, and you'll be able to see this one. By the way, you'll also be able to see a list of all the webinars that we've offered in the last, I think right now it sits at about 13 months. It's usually 12 months, but since we just turned a month here, it's probably 13 months worth of webinars out there. Lots of different topics, marketing and how to start a business and things of that nature. So a lot on digital marketing, a lot on time management, which were 2 subjects that were very popular when we asked you all what you wanted to hear us talk about. There is one more question here from Jacqueline, which is actually right in line with what I was trying to say. Scott, where else would you recommend people go to get some education on these topics, short of doing what Joan recommended, which was to come pay you to do that?
Well, the paid consultant trip is certainly one direction to go to find more answers. It depends, and I don't mean to be flip about it, but if you want to get in the weeds, you can actually go into the IRS website that are currently starting to write position papers on these topics, and you can do as deep dive as that, or there are numerous articles that have been written in places like the Wall Street Journal, that have been written in Forbes magazine. I've seen articles in the New York Times that have delved into these topics. Many of them were written right after the laws had been passed, so you'd probably want to go back a few months, as I haven't seen nearly as much literature on it in the last, say, 60 days as I did in the first 60 days. And then I've personally done some deep dives where I've gone into legal matters that have written, for lack of better terms, white papers on them, and have sat up at night and reading 50-page documents. I don't think I'd recommend going that far, but I think the high-end newspapers that I mentioned are probably the best places to start to find out more about these things.
Okay, all right. Well, let's go ahead and give everybody up the rest of the day. And for those of you that are in Fairfield County, congratulations on having perhaps the first day of spring, although it is May 1st. And thanks very, very much to Scott for a really good presentation. It was great. It was right on point and clear and crisp. And again, it will be available probably by the end of the day or for sure tomorrow at our website. Also a reminder that we are running currently 2 webinars a month, and this doesn't mean every other week. Like I said at the beginning of this webinar, we're going to do our next one on May 8th, 1 week, Jumpstart Your Startup. I know from being at SCORE for 4 years that we have lots of clients who are either currently working somewhere and thinking about starting their own business, and it's a big, big nut to get over initially. And so hopefully that'll be helpful. And it feeds right into a series called Simple Steps, which is a series of workshops that we conduct in Fairfield County, which will even get into the details of the startup mode. So on behalf of SCORE, I thank all of you for attending. Please visit the website. You'll find lots of good tools and frequently asked questions there. Look at our workshop schedule, and a big thanks again to Scott and everyone, and have a great day. Thank you very much.